Hi, my name's Rhett Kessler. I'm the joint fund manager for the Pengana Australian Equities Fund together with Anton Duprier, and I'm here to talk about or provide you an update with the 12 months ended December 2019. It was a remarkably strong year. We had a very strong bounce back, particularly in the second half of the year. Once again, it was our long-held big investments that carried the weight of generating the 19.7% return for the 12 months. So it was our Credit Corps, our CSLs, ResMeds, Aristocrats, Telstras. We did have some missteps. We'd like to think of them as temporary missteps in terms of our SG fleets, our Smart Salary and our Clearview, where the companies have hit some bumps, but we think that the decent management and the strong business models will return those businesses to growth, both in terms of the underlying earnings and their share prices. Generating these returns were not easy during the year, particularly given the gyrations in equity markets during 2018 and, to be frank, during 2019. Our process of safety first, so having powder dry and insurance protection through the puts, certainly allowed us to take big positions in stocks where we had strong conviction. Hence, our big positions in Credit Corp, CSL, Telstra and Aristocrat. So the challenge at the moment is, where do you put your money? And it's tough, both for retail investors and institutional investors and professional money managers like myself. We're really caught because the cost of money is exceptionally low. And the returns being generated by most investors in the traditional term deposits or fixed interest, or even property investors, is just ridiculously low. And when I say ridiculously low, I'm already taking into account the fact that inflation is almost 2%, and the yields you're getting on these investments, particularly term deposits, is substantially below that. So the real value of your money is actually declining. So what do you do? Well, we think it's never been more important to have discipline and deep research into finding that arbitrage of mispriced stocks with good outlooks, backed by very, very solid business models and competent management. It's really important to know that everybody's feeling this pain, everybody has FOMO, and so the weight of money moving out of term deposits, where retail investors are squealing, they need returns. And you can see the weight of that money coming into the market, a lot of it through ETFs or exchange traded funds. And that's why January has started with a bang, as money tries to squeeze its way into both the Australian equity market and generally around the world. Now, we've had some hiccups with the coronaviruses and some of the bushfires, etc. But still, the ever-present weight of money forcing its way into the market continues to drive equity prices higher. And our job is to try and find safe investments that will continue to generate decent returns while maintaining capital preservation. So how have we done this? Well, we've adopted a balanced approach. As always, we like to have some powder dry for opportunities to present themselves. Secondly, we like to have some insurance by buying puts. And thirdly, and probably most importantly, we like to be disciplined about the businesses that we own. They need to be economically insensitive, and we've seen that as the coronavirus hit equity markets, our portfolio stood up exceptionally well, because they're not economically sensitive businesses that we own. They have power over their suppliers, their customers, their competitors, their stakeholders. And it's this focus that has allowed us to preserve capital every single year for the 12 years since inception and generated our 10% plus return per annum. We hope to continue to doing this, and we think it's still possible, but it's not easy. Thank you.